Welcome everyone to today's explainer. If you're a focused learner trying to uncover the actual mechanics behind market success, well, you're in the exact right place. Okay, let's dive into this, because today we're tackling a topic that will completely change how you view financial markets. We're pulling back the curtain on day trading, and specifically, we're looking at trading psychology, the brutal truth behind the charts. This isn't about magical indicators or some secret formula. Now, it's about the raw, unfiltered reality of what it actually takes to survive out there.
90%. Just let that sink in for a second. That is a staggering statistic pulled directly from our source material. 90% of all traders fail. They lose money, they blow up their accounts, and eventually they just walk away from the markets entirely. But why? I mean, when there's literally so much free information available today, why is the failure rate still so phenomenally high? Well, that's exactly the core mystery we're going to solve in this explainer today.
Section 1. The 90% Failure Trap. The Internal Battle.
To really understand this massive failure rate, we first have to realize that it's actually not due to a lack of hidden technical strategies. It originates from something wired directly into the traders themselves. So we have to ask a pretty provocative question. Why do smart people still lose money? You know, trading is so often marketed as this intellectual pursuit, right? Like a puzzle to be solved with better math or hyper-complex charts. But the reality exposed by top trading psychologists is that trading is actually a battle against your own nervous system. When you're sitting there sweating over a red candle, the decisions you make aren't driven by logic. They're driven by panic, by greed, and by pure, raw instinct. A perfect example of this internal battle is something called action bias. This is the psychological urge to do something, literally anything, even when waiting patiently is mathematically the far better decision. Our brains are basically hardwired to equate doing things with making progress. So when a trader is staring at a wildly fluctuating market, absolutely craving the rush of clicking buy, they feel this overwhelming urge for constant action. They jump into trades way too early, they force entries just to feel productive, and in doing so, smart people actively destroy their own accounts.
Section 2. Beware the fake gurus. The illusion of shortcuts.
When struggling beginners look for external solutions to internal problems, they very often fall prey to fake gurus. And they always use the same common tactics. They sell secret trading models that simply do not exist. They promise fast, easy money. They focus all their marketing on flashy cars and luxurious lifestyles rather than the harsh realities of risk management. And perhaps most frustratingly, they charge hundreds or even thousands of dollars for information that you can actually learn entirely for free. As our sources heavily emphasize, these gurus are just selling you a shortcut that isn't real.
So, the crucial point is this. You don't need a secret strategy. You need to fix the trader before the strategy. Buying an expensive mentorship course is absolutely not going to cure your revenge trading. A shiny new chat room isn't going to calm your pounding heart during a sudden market drop, and it definitely won't fix your emotional impulsivity. Knowledge without a strong mindset is really just blind confidence, and it will eventually be overpowered by your own emotions.
Section 3. The Strategy Illusion. Overcomplicating charts.
Let's starkly contrast these two approaches. On one hand, you have bad analysis. It's hindsight-driven, it's highly emotional, and it's completely cluttered. It's when a trader randomly marks 10 lines and slaps on 3 different indicators just to justify a gut feeling they already have. On the other hand, good analysis is forward-looking, perfectly structured, and highly actionable. Good analysis simply creates a clear plan that says, if the price does this, I will do that. It leaves you with a structured, repeatable game plan that is entirely free of the visceral highs and lows of emotion.
I absolutely love this quote from our sources, specifically from trading educator JFX. It's the trading equivalent of running on a treadmill. Lots of motion, zero distance covered. Think about it. Flicking through 10 currency pairs an hour, jumping at every single twitch of a candle, logging double the trades just because you feel in the zone. Sure, it gives your brain a massive dopamine hit. It genuinely feels like work, but it provides absolutely zero real progress.
Section 4. Discipline over dopamine. Change what rewards you.
Now, what's really interesting about this comparison is the stark difference in behavior. The dopamine trader is driven by pure emotional reflexes, revenge trading right after a loss, over-trading, and constantly thrill-seeking. But real success, the disciplined trader, is patient, highly rule-based, and quite frankly, incredibly boring. Honestly, if your trading feels super exciting, you're probably doing it wrong. Because if you give in to that dopamine, the consequences are brutal. Just one single time of breaking the rules can wipe out everything you've patiently built over weeks or even months.
The market doesn't generally destroy you with a standard, calculated losing trade. Nope. It destroys you the exact moment you lose control, panic, and completely break your established discipline.
So, how exactly do we fix this? Well, our sources point to a brilliant philosophical antidote to the dopamine-fueled trader, Kaizen. This is the Japanese philosophy focusing on small, continuous, 1% daily improvements rather than dramatic overnight changes. Instead of saying, tomorrow I will have perfect discipline, which, let's be real, never works, Kaizen focuses on slow, identity-based improvements. You build real discipline by getting just 1% better at controlling your impulses every single day, like simply waiting just 5 extra minutes before entering a trade.
Section 5. The boring path to profit. Consistency is key. Let's move on and see how this builds into a really concrete feedback loop. Step 1, learn the strategy. Step 2, apply it. Now, step 3 is where the magic happens. Observe your emotions while trading. Ask yourself, do your palms sweat when a trade moves slightly against you? Step 4, adjust your mindset based on those exact observations. And finally, step 5, strengthen your discipline. This whole loop proves that trading isn't just about mastering a chart, it's an active, daily exercise in mastering yourself. The math of a professional is wonderfully simple. 1 hour of focused work is vastly greater than 10 hours of absolute chaos. Progress in trading isn't measured by the number of hours you sit staring blankly at a screen, and it certainly isn't measured by the number of trades you execute. It is measured exclusively by the number of quality, emotion-free decisions you make following your specific edge.
And the absolute most practical application of that discipline? Position sizing. Position sizing is literal survival. You must start small, and you really must think in percentages of your account, not in dollar amounts. Look, the key isn't to avoid all losses. Losses are entirely inevitable. The real goal is to strictly control your risks so that you simply survive long enough in the market for your edge to actually play out.
So, I'll leave you with this. Will you continue running on the treadmill, endlessly chasing fake gurus and cheap dopamine hits? Or are you ready to finally choose discipline over dopamine? The market is always going to be there. The only real question is whether you will build the mindset required to survive it. Thank you so much for joining me for this explainer today. Remember, start small, focus on that 1% improvement, and I'll catch you next time.